Welcome from me, Guy Monson, to our regular 6-minute strategy. Two events have dominated markets this month. First, the Federal Reserve is expected to join its counterparts in the UK, Canada and the Eurozone in cutting interest rates at its September 17th-18th meeting. This will be a start of a series of reductions, with 2 more cuts expected this year and then a reduction each quarter through 2025, leaving US rates at 3.75% by the end of 2025. The second event was the aftermath of what is probably the world's most important data point, namely Nvidia's quarterly earnings report. The 3.1 trillion behemoth now accounts for 6% of the S&P 500 and was projected to achieve a staggering 115% increase in revenues year on year. Yet even this impressive figure fell short of market expectations, which had hoped for even more. In the event, Nvidia delivered 120% revenue growth, but the stock still dipped by 6% on the day of the earnings report and has fallen further this month in the wake of a possible antitrust investigation by the US Justice Department. Taken together, slower growth, lower rates and AI-related challenges all suggest a change in equity market leadership, which is probably already underway. In the slides ahead, we'll look at how this great equity rotation might play out in practice and what it means for your portfolio. So let's begin by looking at the performance of global markets for the year to date. You can see in the panel that light blue line, the Nasdaq Composite, climbing sharply up almost 20% in the first half of the year as those AI tech-led names power the index higher. That fell quite sharply in the third quarter and we saw a big consolidation. If you look at it another way, the global equity index, we're up 10% and we've broadly flatlined for the third quarter. Interesting, the red line, global equities equally weighted. That's where you put the weighting of a mid-cap and a giant like Nvidia at the same level, showing almost no return at all for the year, showing how heavily it was dominated by just a few giant technology names. Looked at in another way, you can see those styles beginning to evolve if we break the global equity index down. That yellow line, momentum, powered markets for the first part of the year. That's where stocks rise day after day after day, which was what we were seeing in these AI-led tech names. Growth style was also in favour, value and dividend heavily out of favour. But you could see in the third quarter those lines beginning to turn and the probable, or at least possible, beginnings of a change in equity leadership now clear. If you also look at fund manager behaviour, there are some hints that things are changing as well. These are 2 charts from the famous Bank of America Global Fund Manager Survey, the biggest in the world. And on the left there you can see that the first time in 15 years, global investors are overweight a defensive sector like utilities, showing, if you like, a change in their perception of market risk. On the right-hand panel too, they're beginning to get a little bit more sceptical about this AI rally. If you ask them, do you think AI stocks are in a bubble? Still a majority say no, but the 43% who say yes is rising. So a little bit more scepticism beginning to appear in the market. So if we're right and this great rotation has already started across equity markets, can it be achieved without triggering a major market correction? Well, I think it can for 3 reasons. Firstly, unlike the internet bubble of 1998-2000 in the right-hand panel, most of the rally today is driven by strong underlying profits growth. You can see that in 1999-2000 that blue bar earnings was small, the yellow bar, which was the vast expansion in PE multiples, which was so unstable, was very big. Today it's exactly the reverse. Most of the return has come from real earnings and profits, and that gives us a much deeper foundation to the rally we've seen this year than what we saw 20 years ago. The second reason I'm reasonably confident is the economic backdrop is quite beneficial. In the left-hand panel you can see US inflation measures coming down nicely at the core and headline level, while those labour markets which so need to ease show signs of slowing. Openings are falling, new hires are falling, and people are less reluctant to quit their job because they fear they may not find another one. Now we'll hear more from the non-farm payrolls, which we are due to see on Friday, but the message is a soft landing looks like the likely outcome for 2025. And this will allow the US Federal Reserve to cut rates. We're expecting about 2 to 3 cuts in the fourth quarter of this year, and then a cut every quarter to the end of 2025. Thirdly and finally, if we do rotate into some of these unloved areas like dividend strategies and value, the underlying numbers are looking good. Global dividends are projected to grow an extraordinary 11% in the year ahead, despite the underlying inflation rate being just 2.5%. This is very attractive. Meanwhile, companies are still very confident to deliver big share buybacks, particularly the banks and some of the more defensive names. So the underlying backdrop for a change in leadership towards more traditional industrials, value stocks and dividend plays is quite attractive. So we're beginning this handover, we're beginning to play this great rotation, we're moving with care, we've made great money in the first half of the year in many of these tech names, but things are starting to change. We'll track this progress in the slides ahead in coming conversations. Thank you very much.